What if I told you that a small $1,000 investment today could potentially grow into over $6,000 by 2030, or just as easily disappear altogether? This isn't a meme stock. This is an honest company building the future of power semiconductors, and it goes by the name Navitas. In this video, we're exploring the real potential and real risk of investing in Navitas Semiconductor Corp and two other stocks. And trust me, by the end, you'll know whether these stocks are hidden gems or ticking time bombs. But first, to celebrate reaching 1,000 subscribers, we're offering a free guide that explains how top investors identify breakout stocks. Check the link in the description. If you find value in this video, please like, share, and subscribe so you don't miss out. And remember, this isn't financial advice. It is for educational and informational purposes only. Always conduct thorough research. Investing involves risks and some level of speculation. Thank you. Let's begin with the fundamentals, because knowing what Navitas does is essential to understanding why it matters. Navitas Semiconductor, ticker symbol NVTS, is a US-based tech company leading in power electronics. Their main achievement? Developing GaN and SiC, that's gallium nitride and silicon carbide, semiconductors. These chips are faster, smaller, cooler, and more efficient than traditional silicon chips. They're already used in AI server racks, electric vehicles, solar inverters, and fast chargers. In fact, they've shipped over 250 million GaN devices, and their chips power major brands, including Tesla suppliers and NVIDIA partners. But here's the twist. Until recently, Navitas was just another niche semiconductor company. But in May 2025, they announced a partnership with NVIDIA to power ultra-efficient AI data centers. That news alone caused the stock to soar over 120% in just a few days. Suddenly, Navitas wasn't just a small-cap innovator, it was a contender. They followed that with product launches in EV fast charging, solar, and bidirectional power systems. And just when people thought they might slow down, they announced a major manufacturing partnership in Taiwan to begin scaling up 200 mg GaN chip production. But don't get too excited just yet. Yes, the risk most investors are ignoring. Let's hit the brakes for a moment. While the upside potential is real, so are the risks. Navitas has never turned a profit, not once. Their quarterly revenue stays around $15 to $18 million, but they're burning through cash at a rate of $15 million each quarter. Yes, they raised money recently, but dilution is becoming a genuine concern. If they can't turn a profit soon, additional fundraisers might be needed, which would hurt current shareholders. Navitas is fabless, meaning it relies on third parties, such as TSMC or PSMC, to manufacture its chips. If anything goes wrong in that supply chain, delays, yield issues, or geopolitical disruptions, their production comes to a halt. Competition isn't left out. Let's not forget the giants: Infineon, Wolfspeed, Texas Instruments, and Power Integrations. These companies are already competing in the same market. They're bigger, richer, and more vertically integrated. If Navitas wants to win this race, they'll have to be faster, cheaper, and smarter, consistently. But before we judge too harshly, let's consider the possibilities. What happens if you invest $1,000? Let's say you buy 111 shares of NVTS today at $8.98 as a pop. That's a $1,000 investment. Fast forward to 2030. What could it become? Well, the outcome splits into four possible futures, and you'll want to stick around for the last one because it's brutal. Let's break them down. In the most optimistic scenario, Navitas executes perfectly. AI data centers explode in demand. EV adoption skyrockets. Their partnerships with NVIDIA, Enphase, and Chang'an Auto deepen. They hit $600 million in annual revenue and became a top 3 player in GaN technology. In this future, NVTS could be trading at $40 to $60 per share. That's 4 to 6 times your investment. Your $1,000? Worth up to $6,600. Sounds good, right? But not every story ends with a rocket ship. Let's balance things out. Now let's assume Navitas grows steadily, but not explosively. They gain modest traction in consumer electronics, some success in EV fast charging, and limited wins in AI. They are expected to reach approximately $300 million in revenue by 2030 and achieve profitability by 2028. Stock price? Somewhere between $15 to $25. That means your $1,000 could become $1,500 to $2,550. A solid return, but not a life-changing one. This is the most realistic outcome if they stay in the game but never dominate it. Now, here's where it gets dicey. What if demand for GaN slows down? What if competitors push Navitas out of key markets? Or worse, what if they can't scale up their manufacturing in time? Suddenly, their stock falls to $2, $5. That $1,000, it drops to just $220 to $560. And sadly, that's a future many retail investors don't prepare for. But there's one more scenario, and it's the harshest one of all. The worst-case collapse. In this scenario, Navitas burns through cash, misses too many revenue targets, and gets delisted. The tech is good, but poorly executed, and they can't compete with larger players. Eventually, they sell off their IP, or worse, file for bankruptcy. Your $1,000 gone. That's the risk you take in this sector, primarily with early-stage speculative tech plays. But don't click away yet, because here's the part that ties it all together. Should you invest or walk away? So, what should you do with this knowledge? If you believe GaN and SiC will drive the future, have high risk tolerance, and can wait 5+ years, then a $1,000 investment could make sense, as a speculative bet, not a core portfolio holding. But if you want stability, dividends, or guaranteed returns, this stock is probably not for you. That's not to say Navitas won't succeed, but it's a bet on execution, adoption, and strategic timing. And in the semiconductor world, those three things can make or break a company. If you found this breakdown helpful and want more in-depth analyses like this, consider subscribing. I uncover the real stories behind the headlines and break down companies that the mainstream media often overlooks. So maybe you're curious about Navitas, but you're not ready to throw all your chips on the table just yet. Good, you shouldn't, because while Navitas offers massive upside, there are two other contenders in the wide bandgap semiconductor race. That might just fit your investing style a whole lot better. Let's break it down. First up, Navitas Semiconductor, the ambitious underdog. They have around $86 million in cash and no debt, which helps. But execution risks are very real. If they win, your return could be huge. But if they miss, you could lose it all. Now onto their bigger, meaner cousin. ON Semiconductor, the safe, profitable play. ONEMI is the balanced choice. They're not as flashy as Navitas, not as risky as Wolfspeed. However, they are profitable and experiencing rapid growth. They generate a staggering $8.5 billion in annual revenue. They supply chips to Tesla, Rivian, Hyundai, and more. And while they make a wide variety of products, they're heavily investing in SiC, and they've even acquired their wafer supplier to secure the supply chain. With over $2.5 billion in cash, they have one of the strongest balance sheets in the industry. Think of ONEMI as the blue chip of the power revolution. ONEMI plans to announce its financial results for the second quarter, which ended July 4, 2025, before the market opens on Monday, August 4, 2025. This may have a direct impact on the short-term valuation of the company's stock. Not explosive, but extremely dependable. So, which one is right for you? If you're looking for a moonshot with high upside, Navitas might be your play. If you want a mid-risk, mid-reward bet on a leader in a booming technology, the third stock might be. But if you want solid fundamentals, real earnings, and a lower risk path to semiconductor growth, ON Semiconductor might be the one to watch. Moving on to the third pick, ST Microelectronics ticker STM navigating a storm. Plotting a pivot. In an industry known for rapid cycles and relentless innovation, ST Microelectronics, STM, has been anything but idle. Yet, the Geneva-based semiconductor giant finds itself at a crossroads, caught between earnings disappointment, strategic expansion, and a roller coaster market performance that has investors questioning the next move. As of Thursday, STM shares slid to $26.22, retracing from July's peak above $31, a level not seen since early 2023. The pullback isn't just technical, it's fundamentally driven. Kicking off the second quarter earnings season, STM reported a net loss of $97 million, translating to 11 cents per share. On an adjusted basis, the figure stood at 6 cents, well below Wall Street's estimate of 10 cents, according to Zacks Investment Research. The gap was unmistakable, and investors reacted swiftly. While revenue exceeded expectations, coming in at $2.77 billion versus the anticipated $2.72 billion, the shine was dulled by broader operational issues. The implication is clear. STM is dealing with slower product turnover, a red flag in a sector driven by velocity and margin. Notably, automotive revenues came in weaker than expected, a surprise for a company that has long positioned itself as a critical supplier to the EV and ADAS markets. Management attributed the shortfall to specific customer dynamics. Still, the broader issue may lie in a book-to-bill ratio that has fallen below parity, signaling potential softness in future demand. In short, the backlog isn't building fast enough to instill confidence. Despite the storm clouds, STM isn't retreating. It's doubling down on strategy. In a bold move, the company has agreed to acquire NXP Semiconductor's MEMS sensor business for up to $950 million, comprising an upfront payment of $900 million and $50 million in milestone incentives. This acquisition, expected to be immediately accretive to EPS, aligns tightly with STM's ambitions in automotive safety and industrial automation. The MEMS unit generated approximately $300 million in revenue in 2024, offering STM not only diversification but also deeper penetration into mission-critical sensing technologies. By integrating NXP's MEMS innovations, STM aims to strengthen its competitive moat, expanding its sensor portfolio across automotive and industrial verticals, both of which are poised for exponential growth as AI, edge computing, and autonomy become mainstream. Technical snapshot: opportunity or overhang? Zooming out to the stock's performance, STM remains up 5.03% year-to-date, a modest gain in a hyper-competitive semiconductor landscape. From January to May, the stock oscillated between $22 and $26, constrained by macroeconomic pressures and the normalization of the chip cycle. Then came a breakout in late May. Volumes surged, and STM mounted a steep climb to $31 by mid-July, reflecting investor enthusiasm, likely driven by optimism around guidance and AI-driven industrial tailwinds. However, the recent earnings miss has triggered a swift correction, bringing STM back to $26, where it now flirts with key support levels. Today's trading volume of 1.2 million shares is relatively light compared to the daily average of 7.2 million shares, suggesting investor indecision ahead of the next catalyst, Q3 earnings, scheduled for October 23, 2025. So, where does this leave prospective investors? On one hand, STM is repositioning itself with a savvy acquisition and remains a core supplier to high-growth sectors. Its long-term exposure to EVs, smart manufacturing, and energy-efficient systems is unmatched in Europe's semiconductor ecosystem. On the other hand, margin pressure, falling book-to-bill ratios, and weak cash flows paint a murky near-term picture. If execution falters or macro demand softens further, the stock could slip below $24.50, a level that would invalidate the current recovery narrative. ST Microelectronics is no stranger to reinvention. While this quarter may have rattled some investors, the long-term thesis still holds, provided management can regain operational efficiency and deliver on the MEMS integration. The stock may be down, but it's not out of the picture. For investors with a tolerance for volatility and an eye on strategic growth bets, STM may well be a buy-the-dip opportunity hiding in plain sight. The best part? You don't have to pick just one. You can build a mini portfolio around the future of energy efficiency and own a piece of each tier: startup, scaler, and established leader. So now the question is, which would you choose? Let me know in the comments. And here's your challenge. In the comments, tell me, would you invest $1,000 into Navitas today? Why or why not? However, please note that this video doesn't constitute financial advice and is intended for educational and informational purposes only. Investing in stocks is a risky endeavor, as past performance doesn't guarantee future outcomes. We're anticipating huge potential in AI stocks, but we don't know which one exactly, as we have revealed some that have stronger long-term fundamentals. Check the following video. Until then, invest wisely, think long-term, and always do your due diligence.